Good evening, everybody. Sorry about starting late. Novia usually has glitches that we have to fight through. So tonight we have the great pleasure of having Jeff Kennedy on. He is one of your top experts in Elliott Wave trading. So I put up his bio, so I'm going to let Jeff take it away. Jeff, welcome to the Candlestick Forum. We're anxious to see your information.
Awesome. Thank you very much, Steve, for having me. I really appreciate that. And for everybody who's joined us for the presentation, I would like to say thank you very much for sharing your time with me. And before I begin, I will say that I will do my best to make sure that it is time well spent. Now, what I tend to do, or my approach to the market, of course, is that of an Elliottian. I've been with Elliott Wave International for 25 years plus now, working with Robert Prechter. In addition to being an Elliottian, I'm also a professional technical analyst. I hold multiple designations with a number of associations. But really, at the end of the day, in addition to teaching, my passion is trading. So what I'm going to be showing you tonight is kind of give you a very quick introduction to the Elliott Wave principle, and then discuss how I combine actually Japanese candlesticks into the mix as well. Being a technician, I tend to utilize a lot of different tools, or a number of different tools. I don't simply like to rely on a single technique or a single approach. So let's go ahead and get started. That's my little intro. Now, for those of you who may not be familiar with the Elliott Wave principle, it is a form of technical analysis that essentially classifies, or that basically provides a context for market action. And the way it does that is it classifies price action into two distinct modalities. One modality is what we refer to as motive waves, and then the other modality is that of corrective waves, or counter-trend price moves. What you see in front of you is an impulse wave. This is one of the two types of motive wave patterns, the other being an ending diagonal. And you can see that in the next slide here. So as far as motive waves, we have two patterns, the impulse wave and the diagonal. Now, if we go back to the impulse wave diagram right here, the significance of the formation is that it tends to denote the direction of the larger trend. And what we have here, waves 1, 2, 3, 4, 5, just a classic, clean, clear 5-wave move to the upside. Notice this notation right here where I say 5, 3, 5, 3, 5. Basically, all that means is that wave 1 subdivides into 5 waves, wave 2 subdivides into 3 waves, wave 5 subdivides into 3 waves, 4 and 5, also a 3, and then followed by another 5-wave move. The ending diagonal, this is a 3-3-3-3-3 pattern, meaning each wave subdivides into 3 smaller waves, specifically a zigzag or a variation thereof, typically a double zigzag. Its formation is a little bit different. If you're familiar with Edwards and McGee, a lot of the old school work on technical analysis, you might refer to this as a rising wedge. Now, from an Elliott Wave perspective, we tend to have a number of rules and guidelines which actually govern the development of the ending diagonal. So it's actually a lot more, we're more strict in its actual identification. Now, the other patterns we're going to look at next, these would be the counter-trend moves, the corrective wave patterns. We start off with a zigzag, which is a 5-3-5 pattern, meaning that wave A subdivides into 5 waves, wave 3 subdivides into, wave B subdivides into 3 waves, and wave C subdivides into 5 waves. This is a zigzag. Typically, you'll encounter this as a counter-trend move within an uptrending market, roughly probably 60% of the time. The other portion of the period of time, you'll see flat structures. This is a flat where we have 3 waves down in wave A, a 3-wave move up in wave B, followed by a 5-wave move decline in wave C. And then, of course, we have the triangle. Contracting triangle, each wave subdivides into 3 waves, identified as waves A, B, C, D, and E. It's really easy to identify a triangle on a price chart simply because it's a sideways price move. So I know that was kind of a real quick synopsis of the Elliott Wave principle, but what's most important to understand about what I've shown you thus far is that everything that we know about the Elliott Wave principle stems from these 5 core patterns. Everything that we know, everything that we work with, basically is this what I've just shown you as far as these 5 patterns. This is the foundation. Everything originates from these 5 patterns. For example, if we go back to the flat structure right here, there's a variation to the flat pattern, and that's referred to as an irregular or an expanded flat, and that occurs whenever wave B terminates beyond the origin point of your wave A. So the structure would look something like this, where you have a 3-wave move down in wave A, and then a 3-wave move up in wave B to a new extreme, and that 3-wave advance would look something like this. And then you would see your 5-wave decline in wave C, again marking the culmination of the overall corrective structure. So basically what this would be simply a 3-wave move to a new extreme. So this is a variation of the actual flat pattern referred to as an expanded flat. Another variation of this formation is a running flat, and that occurs when wave C fails to move beyond the wave A extreme. Now, one thing I like to do after I show everybody what the 5 core actual patterns are, I then like to share with people what we can anticipate from each one of these formations. And if we go back to the impulse wave, the implication of this structure, the implication of having a 5-wave move complete, is that if we apply the Elliott Wave guideline concerning the depth of corrective waves, that would argue for retracement back to near the previous 4th wave extreme of 1 lesser degree. So whenever you have a 5-wave move complete, this is what we can anticipate. This is how we make a forecast from an Elliott Wave perspective. Now, if we go back to the ending diagonal formation, well, this is kind of an exciting pattern. And the reason why is because as a terminating pattern, it may only form in the 5th wave position of an impulse wave or as wave C of either a zigzag and or flat. But the implication of this structure is that you're going to see a very swift, sharp move back to below the origin of the pattern, and typically we're going to do so in 1/3 to 1/2 the time it actually takes the structure to form. So if we spent 3 weeks actually forming this pattern, then say 1 week to maybe maybe 8 trading days, we would actually expect a complete retracement of that structure. Now, if we go back to some of our corrective wave patterns, of course, the zigzag, because it's a correction, simply put, it's a counter-trend move. And most often, it's going to be contained within parallel lines, as you see right here. So whenever you see something like this, the implication, or what we're able to do from an Elliott Wave perspective, is then forecast an advance back to beyond the actual origin of the pattern, as you can see right here. A flat, very similar. Here's the origin of the pattern, so what we can anticipate moving forward is a complete retracement of the structure, or in other words, simply a resumption of the overall larger trend. Now, if we go with the triangle, pretty much the same thing. We would anticipate what we refer to as a triangle thrust. Now, what's important to remember about the triangle, it's very limited as to where it can actually occur within the overall Elliott Wave structure. It can only form by itself in the wave 4, B, or X wave position, meaning that whenever you see a triangle, it's basically the market's way of kind of giving you an early warning signal, because typically what's going to happen following the triangle is one more final push up, typically a 5th wave, sometimes maybe a C wave, and then that's going to mark the end of the entire larger structure. So triangles should be best treated as warning signs. The party is almost over. That's also what you can anticipate as far as the resolution of each one of those patterns. Now let's talk a little bit about trading. Now what you're looking at here in this diagram is what I refer to as a complete 8-wave Elliott cycle. And what we have in front of us, we have 8 waves. Waves 1, 2, 3, 4, 5, 6, 7, and 8. That's how we come up with a complete 8-wave cycle. 5-wave move up, 3-wave counter trend move. Now, from a trading perspective, I want to identify primarily the 4 trading opportunities that this structure actually offers. And I discuss this in greater detail in my book called The Visual Guide to Elliott Wave Trading. That was written by myself and a good friend of mine and colleague, Wayne Gorman, where we actually go through the application of the Elliott Wave principle, not from, say, an academic perspective, which is what you'll get in the Elliott Wave Principle book written by A.J. Frost and Robert Prechter, but we look at the wave principle more as a trading tool. And in that book, you'll find a chapter on what are the best waves to actually trade. And these are primarily the four primary trading opportunities an 8-wave cycle it offers. And the reason why is because each one essentially is positioning you in the direction of the larger trend. Now, this suits me just fine because I'm very much of a trend trader. So what I like to do is focus on a market that has a very well-defined trend, and then I tend to focus primarily on the trending moves. So wave 2 is a setup for wave 3. Wave 4 is your setup for wave 5. Once you have 5 waves up, you're looking for the decline. Within the decline, wave B, that's going to be a counter-trend structure as well. Then you'll see the final wave C sell-off. Now, of the 4, I've often been asked that, okay, since these are the 4 primary trading opportunities, which one's my favorite? Or which is the one most people seem to be interested in? Well, of course, most people like this one. This is their favorite trade setup because typically within an impulsive structure, wave 3 is the move or the wave where prices tend to travel the farthest in the shortest amount of time. Okay, so everybody likes wave 3, and the reason why, again, is because that's where you get the big move. My favorite trade setup, though, is this one. And the reason why is because once you have a confirmed wave 3 behind you, wave structure demands that you're going to correct that move and then see one more advance in wave 5. So really the probability of this trade setup working out is quite high, better than 80, almost pushing maybe even 90%, because you do get into a question of a truncated wave or a truncation. Truncated waves are very rare, actually, less than 10%, maybe even less than 5% of the time. But this is actually my favorite trade setup because it offers me the highest probability of success. Granted, this setup here offers me the greatest probability of return, or as far as percentage gain or equity increase, but this one, this is where I really have the odds on my side. So this is the setup I prefer out of all 4. Now, the way I combine candlestick analysis with these Elliott wave patterns, I utilize candlesticks to really identify turning points. I think it's very, very valuable in that respect. So what I like to do is this. This would be an impulsive advance. Say it's wave 1, call it wave A, whatever you want, it doesn't matter. What I'm focused on is the ABC decline. This would be a zigzag. So really at the final stages of the move, if we go back to our 8-wave cycle, essentially what I'm looking to see form on the price chart, not utilizing an open, high, low, close price chart, but a candlestick price chart, is at the termination point of, say, wave C. This is where I want to see some type of significant or reliable candlestick formation, such as a morning star, bullish engulfing pattern, 3 inside up, doesn't matter. In fact, I look at the candlesticks in addition to momentum and also overall Elliott wave structure to help me fine-tune and identify these extremes, the wave 2 extreme, the wave 4 extreme, the wave 5 extreme, the wave B extreme, and then subsequently over here to the right, the wave C extreme. Now, next, I'd actually like to show you some price charts that I spoke about, or I've spoken about in one of my services at Elliott Wave International. I'm the editor-in-chief of 2 products, actually. One is I am the chief commodity analyst at Elliott Wave. I've been in that chair for roughly 10 years now, actually, over 10 years. So I've been doing that. And I also do another service called Traders Classroom, and that service is primarily geared toward teaching. I teach people about technical analysis. I teach people about the wave principle, candlesticks, momentum, indicators, oscillators, how to utilize them correctly, how not to utilize them, and of course the Elliott Wave principle in certain trading techniques. So these are some of the markets that we've been working with or looking at in Trader's Classroom, and one of them is Goldman Sachs. And the reason why I've been discussing Goldman Sachs for a number of reasons is because it's a good illustration of what an impulse wave actually looks like, utilizing an open, high, low, close price chart. So with waves 1, 2, 3, 4, 5 in place, clearly evident, we can apply the Elliott Wave guideline regarding the depth of corrective waves, and that would call for a sell-off back to, say, the 220 handle. This is where my candlestick analysis comes into play. So what I'm going to be looking at very closely right now is, are there any kind of clues to identify that we do indeed have a tradable top in place? I may look at the weekly price chart, may look at the daily price chart. I know when we were working the pullback, that low that occurred in early February, we were identifying this in Trader's Classroom as simply a three-wave counter trend move. Waves A, B, C, three-wave decline, perfect fourth wave structure. What helped me identify the culmination of that move? Clearly the morning star formation on the daily chart level. Another stock that we've been looking at in Trader's Classroom has been this one, Lexan Pharmaceutical. And the reason why it's a good example of what a flat pattern is. If you recall from the earlier slides, a flat, basically you have your move down in wave A, then you have your move up in wave B, which ends at or near the origin of wave A, and then you have the wave C decline. And then that sets the stage for the big advance or complete retracement of the move, okay? So this is a bullish flat. What you see in the price chart is actually a bearish flat. The pattern begins at this point right here, and then you have an up congestion point. That's actually a small triangle, then the final advance. So this is a three-wave move up. That's a three-wave decline. This is the ending diagonal that we discussed. So we have 3, 3, 5, completed pattern. So moving forward, I'm looking for the ALXN to actually continue much lower. What can I look at that would actually support this interpretation? Well, again, this is where candlestick analysis comes into play. What we actually have seen the last few trading days in this market, notice we have a candle here with a green real body and there's a yellow box around it. That simply identifies that candle, basis my charting software, as a bullish engulfing pattern. Now, the reason I call it a failed bullish engulfing pattern, because as you know, with candlestick work, if you encounter a bullish engulfing pattern, that tends to argue for additional advance over the next 1, 2, 3 to 5 additional candles. Well, in this case, that idea didn't come to fruition. And in fact, very shortly after the formation of the bullish engulfing pattern, we actually traded below it. This is what I refer to as a failed bullish engulfing pattern. And also, too, notice the big candle that actually caused the breakdown in this market. These three formations right here, these three candles, I refer to that as a three inside down formation. So what we have here essentially is a failed buy signal. From a trading perspective, what I've realized or what I've observed is sometimes the best buy signals are failed sell signals, and sometimes the best sell signals are failed buy signals. In this case, we have a very bullish candlestick pattern, but it failed. Also, too, we also have another formation here, which is equally bearish. So moving forward, I will be looking for a Lexan to continue much lower. Another issue that we've talked about in Trader's Classroom has been CDW Corporation. Nice impulsive structure to the upside. I'm watching it closely right now because I think we are close to finishing wave 5 of a larger impulsive structure. Notice we have wave 3. So moving forward in time, I'll look for another decline, probably 56, 54, and then still further rally on up to the 68, 70 handle. That's essentially what I'm looking at. But really the story here in CDW was the pullback here, because we were also able to identify that as a counter-trend move within a larger uptrending market. So as we left February and we moved into, as we left in January and moved into February, we were essentially bullish on the CDW. And one of the things that actually did indeed help that outlook, well, clearly you can see the nice bullish engulfing pattern on the weekly price chart. So this is how I combine candlestick analysis, Japanese candlestick analysis, with the Elliott Wave principle. It allows me to kind of fine-tune my work, also fine-tune the turning points, and in many instances will also offer me some very precise levels to trade against as far as a breakout point or an initial protective stop. So that's about it for, I guess, my dog and pony show. I'm more than happy to answer any kind of questions if anybody has any questions. Anyone? Well, I see a few little comments coming in, I guess. I'm not sure which way we're coming up. Okay, to the downside. Kevin, the Elliott Wave International is located a little bit about an hour north of Atlanta, Georgia. As far Joseph, does the wave principle work on multiple time frame? Well, yeah, of course it does. All forms of technical analysis work on multiple time frames, regardless of whether we're looking at, say, for example, an intraday price chart, 60-minute, 5-minute. I've used the wave principle even successfully on, 1-minute, 5-minute price charts. How are you using the Dong-Hyun channels? I primarily utilize the Dong-Hyun channels, Bill, as kind of a visual that gives me a good visual of what the trend of a market is. And also, too, what I've observed is the center line of the Dong-Hyun channel, which is referred to as a Dong-Hyun average. And just so you know, this was developed by Richard Dong-Hyun. It was popularized by the turtle traders back in the 80s. It's a very valuable tool. But what I tend to look for is I look for that Dong-Hyun average to act as support for a counter trend move in price. So it was nice to see this slow, choppy decline in CDW back down to that Dong-Hyun average, and then boom, there we get the bullish engulfing pattern. So this turned out to be a very nice trade. Can wave Y and a complex correction be a triangle? Tai, that was an awesome question because the question is a very advanced application of the Elliott Wave principle. And just so you know, I'll repeat the question. Can wave Y of a complex correction, which is what he's referring to, is something we call a WXY. All that is, it's two corrective wave patterns joined together by an X wave. Okay, if I go back to my prior slide here, I'll show you again what we're essentially doing. If I don't crash my computer, when you have a combination, like for example, a double zigzag, all that is, it would be two zigzags together. So for example, just to be real quick here, let me delete this, delete that. And we would use the notation of this. This is my template I sometimes use, where we have W and an X and a Y. What exactly is WXY? This denotes a combination, a combination correction. And in other words, what you'll see is, say, for example, utilizing the zigzag, you'll have an ABC for W, then you'll see another counter trend move, and then another ABC decline. So can this final move, wave Y, be that of a triangle? And yes, it can. And there's a great example of that actually in the book, and that's Elliott Wave Principle by A.J. Frost and Robert Prechter. So great question there on that. Wow, lots of questions, guys. Lots of questions. I really appreciate this. A lot of questions always makes this a lot more fun. From Glenn, how do you determine where wave one starts? Well, let's pull up a price chart. Let me see. I always begin, I would say, at a significant extreme. Is there anything in particular, Gwen, that you're looking at? And we'll have some fun with it. I'll pull up a real-time price chart, and you can kind of show me what I'll show you what I'm doing. So, Gwen, anything in particular you're looking at? And we'll try and find a first wave move. Now, many times I don't try and trade that first wave move. I'm really focused on the other setups. I'm very much of a trend trader. I like to trade in the direction of the trend. I want the wind at my back. A great book that really shows the wisdom in that approach is the Market Wizards book by Jack Schwager. What you'll find when you read that book, which is nothing more than a compilation of interviews with some of the world's best traders, what you'll find is that the majority of them are trend traders. They don't pick tops and bottoms. That's kind of a cowboy thing or an ego-driven style of trading. But also, too, the majority of them understand technical analysis, and also, too, a lot of them know what the Elliott Wave principle is. So that says a lot about what we do as technicians, not only candlestick enthusiasts, but also Elliotticians as well. So let me get back to catching up with some of the questions here. What is the minimum amount of bars that can one use for Elliott Wave evaluation? Well, I was actually having fun. That's a great question. I was actually having fun with this stock the other day in Trader's Classroom, and this is Snapchat. Okay, and there we go. Hold on, give me a moment. And basically what I was addressing in that lesson was that you might think that you really can't do anything, certainly from a technical perspective, looking at this price chart from a technical perspective, because you only have a few days worth of price action. Well, I disagree. I think there's a lot of information that we can derive from this price chart. For example, what do we have right here? This is a bearish engulfing pattern. Right before that, you have another candlestick with a very, very long upper shadow right here, basically telling you that the market is rejecting the higher prices. And then if we go back to the open, high, low, close price chart, all we have to do is move down to the smaller term time frames. Here's a 15-minute price chart, and what you're beginning to actually see unfold, in my opinion, is an impulsive move down. So I like the idea of moving forward. And again, I could be wrong here, guys, but the way I'm looking at this move, or the way I would actually identify the substructure in Snapchat, is that of an impulsive decline. So we would identify this as wave 1. Subsequent price action is wave 2. Then we have wave 3 down here, and then a subsequent move up for wave 4. Counter trend move. Notice how we also go back and close the price gap, or attempt to close the price gap right here. Very common. In fact, I actually identify that in some of my work as what we refer to as a closing the price gap trade setup. Many times that can actually offer a good opportunity. And then we'll just go ahead and put on our final fifth wave move on the chart right there. Close this out. And so this is essentially what I'm anticipating moving forward, is another route here. And then this, once we do indeed see five-wave decline in this issue, we'll either call it wave A down or wave 1 down, but either way, it will give way to another round of selling. Right back to a 382 retracement. That's significant, and the reason why is because the most common Fibonacci retracement for a fourth wave move of an impulsive structure is indeed 382. The most common Fibonacci retracement for a second wave is a 618 multiple. That might be worth writing down for those of you who do like the wave principle. Fibonacci retracements. Again, the most common Fibonacci retracement for wave 2, 618. The most common Fibonacci retracement for your fourth wave counter trend move of an impulsive structure, 382. And you can see we're right there. We actually went to that area yesterday and began churning down. So if everything goes according to plan, we'll see further decline, probably to below 20, targeting that 19 handle within, say, the next 3 to 5 trading days. This is pretty cool stuff. I really like okay, what's the name of that channel? Chris, what are we talking about? Oh, the Dong-Hyun channel. It's called the Dong-Hyun channel. It was developed by a gentleman named Richard Dong-Hyun. Brilliant analyst. Okay, more questions. Jason, as far as identifying the start of a wave pattern, the best thing to do is work off of a significant high. Like here we have, again, only 5 days worth of trading in Snap, but we're able to make a fairly compelling forecast moving forward. Where do I start? I start at the extreme of the move here. So if we were going to, like, say, for example, look at Walmart, I would begin at the origin of a move. So let's go to the weekly level. So I would begin either working, like, for example, if I'm working a larger pattern in Walmart, then what I want to do is I either want to begin at the high here, or I want to begin at the low here, or possibly this move here certainly looks like a counter trend structure, a three-wave move, so I may want to spend some time looking at that. The time frame that you utilize whenever you're looking at a price chart really depends on your trading time frame. There's no need to look at a weekly price chart if you're, say, short-term or day trading Walmart or short-term or day trading options. There's no need to look at the weekly. It is worthwhile to look at the daily and then maybe move down to the intraday level, say the 60-minute price chart. That would provide some useful information. So really your trading horizon, if it's like 1 to 3 days, you're probably going to be focused primarily on the shorter term price charts. If you're longer term oriented, then of course you're going to be looking more at the daily and weekly type style price charts in a very specific issue. Ernie, there are 3 corrections. Again, this is one of the things I like about the wave principle. I know the wave principle, in some instances, a lot of people, they see a lot of value with it, but they also get confused by it. And I think the reason they're confused by it is simply because it's not taught well. So that's what I try and do whenever I'm teaching the wave principle, is I try and teach it as easily as possible or clearly as possible. Everything we know about the wave principle comes from those 5 patterns that we discussed earlier. The impulse wave, the ending diagonal, the zigzag, the flat, and the triangle. So how many different types of corrective waves? You have 3. That's it. What do I trade? Okay, good question. Do you trade them all or just the common ones recognized? Basically what I look for as a trader, probably the zigzag. It's a clean, clear structure. 3-wave move down and done, contained within parallel lines. I like that. It really depends on the trade setup and the profit potential actually that I can actually make. If it's going to be a good trade, then I'll look to take a shot at it. But the cool thing about the counter trend price move is that it's just that. It's a counter trend price move. So if it's going to offer me a high probability short-term trade setup, whether it's a day trade or whether it's maybe something longer term, then so much the better. More questions? Percent R, Bill. Okay, let me go back to another price chart. These tools that you're looking at here, percent R, okay? This is Larry Williams, percent R, great guy, quite the showman, excellent trader, been in the business a lot longer than me. One of his tools, it's kind of a variation of stochastic, is this, percent R, okay? And what I do, the way I utilize this in my analysis and in my trading is, number 1, I like to use a base level of 50 for my percent R, okay? And also, 2, I like to illustrate it as a histogram. I use a 5 period and also I use a 20 period. Now, the reason I do this is because I let the 20 period essentially identify the mathematical trend of the market. And as long as my red histogram bars are above 50, that tells me mathematically, without any kind of interpretation on my part, because I know sometimes you'll look at a wave pattern and you'll kind of go, what the hell is that? You don't know. It's not clear. This is why I rely on my technical tools, my momentum signatures, my momentum patterns. What I can do here, utilizing this specific tool, the 20 period percent R, is as long as the histogram bars are above 50, I know the trend is up. That's when we look at the 5 period percent R. Okay? if we see a break of the 50 level by the blue histogram bars, when the red histogram bars are above 50, that's telling me that that movement, that decline in price, is a counter trend price move. So all we have to do is look at the histogram bar, the breaks, and identify that was a counter trend move. And then we can do the same thing over here. This was a counter trend move, as was this, as was this, and as was this. So now, from a trading perspective, isn't this a neat tool? Neat, very simple interpretation. In other words, you don't need to be, say, a technician or an Elliottician with 20 or 30 years of experience to identify high probability trades if you know how to utilize your tools correctly and properly. I just showed you a very simple technique utilizing a dual %R setup on your screen, 5 period and 20 period. And what you're able to do, going back for the last, say, 12 months, identify some very phenomenal buying opportunities, all in the direction of the primary trend, which again is my primary trading style. Kind of fun. Also, too, notice how along the way we kept above the Dong-Hyun average. This is a 20-period Dong-Hyun average, by the way. Any more questions? I think we're probably getting close to my time here as far as being through, although I believe Steve's not going to hold me to that. Is there anything else I can help anybody with? Use me while you got me. Bill, okay, where is the first wave move of crude? What's your, let me see, context? Are we looking at a 5-minute price chart of crude oil, or are we looking at, crude going back to 2008? Give me a reference point. Robert, this is a good question to develop an Elliott Wave count. Okay, that's a great question. And we'll have some fun, and we'll do just that. Let me pull up a price chart. Okay, and let me see here. Let's just have a little bit of fun. Okay, I don't know if there's a company called with a ticker symbol of HOP. So I'm going to type in HOP and see if anything comes up. Okay, didn't know that. Okay, Hope. Didn't know there was a stock with that kind of a ticker symbol. So what I'm doing, Robert, is where do I start? Okay, because this is actually the first time I've looked at this price chart. What I want to do initially is identify something that I actually recognize. Now, what I recognize on this price chart is this. This move is very, very sharp, very, very steep. As an Elliottician, I can tell you right now, you see something like that, that's basically a third wave. That's a clue. That's a starting point. Because now, if I know this is a third wave, well, all we have to do is go back and remember the sketch of the impulsive structure. We have waves 1 up, wave 2, wave 3, pull back in wave 4, and then we have our final 5th wave move, okay? So, basically, where we are, this wave right here is this. So where we are within the diagram. So now moving forward, I know I need to see something along these lines. In other words, we still have more to go to the upside here. So what I'd like to do next is move up to a weekly time frame. Okay, interesting. Again, what I'm looking for is something I recognize. What do I recognize here? Well, the pattern I recognize here, remember the running flat? You have a 3-wave move down in wave A, a 3-wave move up to a new extreme, a wave C decline that unfolds, so A, B, C. This is a running flat. This structure, moving forward, looks quite healthy. it looks like you'll probably come back down, take out the intraday low, the low that we saw earlier this year, and then I'll be looking for further rally. So this is one that I'm glad we looked at, because based off the actual structure, it's incomplete. It's an incomplete Elliott Wave pattern. We need more to go to the upside. So what do we do now? Well, we come back down to the intraday time frame here. And what I'd like to see, or the daily time frame, what I'd like to see moving forward is probably a little bit more decline back here. Remember what I said earlier, guys, about the most common Fibonacci retracement for a fourth wave move is a 382 multiple. So maybe something along these lines. There we go. Oh, nicely. So maybe we can get down to that 20 handle. And this would be a great either buy and hold for, say, 6 to 9 months, or if you trade options, I trade options, this would be something that might be worth some attention. But it's nice. Waves 1, 2, 3, 4, 5. This is a flat right here, an expanded flat, A down, B up, followed by a move. This is clearly fourth wave counter trend price action. You will be making new highs. You will be going higher. Once this consolidation is complete, most likely by the end of the month, you will see this going higher. So going back to what you were saying, Robert, where do I begin? I've never seen this price chart before, and that's why I was just like, okay, HOP. But if you understand what to look for, or let me rephrase that. The advice I would give you whenever you're looking at a price chart for the very first time, focus on what you recognize. And typically, there's one or two things that you do recognize, and they're like threads. And you can pull on that thread a little bit more and a little bit more and a little bit more. And before you know it, everything begins to unravel, and you really begin to see some clarity in the price chart that you otherwise would not have seen. Kevin, some believe that the stock market is in the wave 5, possibly wave A down thoughts. Stock market looks good for the next 6 months. I would continue to look higher. Any kind of weakness you see, I think, is nothing more than a buying opportunity. ND, how can you predict this before price has moved? Well, that's the beauty going back to the Elliott Wave principle. We have 5 core patterns that we work with as Elliotticians, and we reviewed this earlier. So what you essentially do with these 5 patterns, you essentially treat them as a roadmap. Okay, remember the price chart of Snapchat, okay? And remember how I was showing you the Fibonacci retracements, how nicely that is. Also, too, this is referred to as an acceleration gap. Acceleration gaps occur most often in the wave 3 position of an impulsive structure of a 5-wave move. Remember the retracements right here? This is why I'm so sold on the wave principle, and why I've basically, I won't say dedicated my life to it, but why I'm so, if you were to ask me 10 years ago, what's the most common Fibonacci retracement for a second wave? Oh, that's a 618 retracement. What's the most common Fibonacci retracement for a fourth wave counter trend move? Well, that's a 382 retracement. We've known this for years. We've known this for going all the way back to since R. and Elliott actually developed the wave principle. In fact, Ralph Nelson Elliott said that the Fibonacci sequence was the mathematical wave principle. So this is not new. We knew this. We've known this going back to the 30s. Okay, here's a price chart of a stock that's only been trading for 5 days, and look at how so nice price action has unfolded in Snapchat according to the rules and guidelines and the observations that Ralph Nelson Elliott identified in the 1930s. I think that's absolutely fascinating. So, and I guess I am pushing my limit here. I'll take 1, maybe 2 more questions, and we'll go ahead and call it a night, guys. Wow. Carol, nice to meet you. Thank you for joining. Let me take a look at this. And I don't know what this is. Oh, therapeutics, car therapeutics. Okay, well, the first thing we need to do is we need to look at, we need to scale what we're looking at. And this might be worth writing down for some of you. There's always a question or a debate when you use or move from log scale to linear scale or linear back to log or arithmetic. You know, how does all this come across? Okay, the scale on this price chart, CARA, Car Therapeutics, this is what we refer to as either linear or arithmetic. Notice the distancing between, say, the 8 and the 6. It's the same distance that you see between 22 and 20. Okay, everything's set up uniformly. Now, whenever the high of the price chart is greater than the low value of the price chart by a factor of 3, okay, 1 to 3. If the ratio is greater than 3, that's when you need to move to log scale. Okay, now if you look at the values over to the right, sometimes this is referred to as a percentage change chart. So notice the distance between 6 and 4 and 8 and 6. It gets tighter and tighter and tighter the move, the farther you go up. So whenever you're looking at a price chart where you've got like a high of 100 and a low of 10, you got to go to a semi-log scale price chart. Now, what I see here is, well, this is a good question. Does anybody see anything that they recognize? Does anybody see anything similar to possibly one of the wave patterns that we were discussing earlier tonight? Maybe? Okay, well, let's just walk through this. Okay, let me go ahead and center the price chart just a little bit to the right. Okay, there we go. Just move this over. And kind of center things. Okay, well, let's just do this. Down, see the move down? And then the move up. Then we have a down move. And then we have an up move. And then we have another down move. Okay? Then, what comes next? Well, we have a move up. Then we have this structure here, and then we have another move up. And notice where the next move up goes to. It goes up to at or near the prior extreme. Okay, now remember, wasn't there a pattern that we called a flat, where you had a 3-wave move down in wave A, a 3-wave move up in wave B, which ended at or near the origin of wave A, and then that was followed by a 5-wave move down. Remember that flat diagram, the 3, 3, 5? Well, in this instance here, I think I would probably call this a 5-wave move down, certainly impulsive. Ended here, that works for me. This looks like we're working in advance, certainly back to beyond the highs what we've seen in this issue, and that would be the high that we saw back in, say, 2015. This is what we can derive from the weekly price chart. Now, as far as the daily price chart, okay, here's where it gets tricky. Now, you may not like my answer as far as what I've got. Okay, now the trend in this market is definitely to the upside. Okay, so I like the idea that this issue is indeed moving higher. Okay, yeah, this is a kind of a very tough interpretation. As far as a chart like this, going back to the weekly, I have no problem being long this issue, okay? My only question is, I'm not seeing a lot of great clarity short term, maybe something along these lines, this final move up. Let's do this. Let's look for the decline maybe back to 14. That should offer a buying opportunity for further rally. Many times what people, one thing that you can do when faced with an interpretation or a wave price chart where you don't know where to begin the count, sometimes it's okay to start in the middle. Okay? That's a very strong move right here. So I'm thinking we're currently working a wave 3 price move. That being the case, I'm anticipating a 4. So we would anticipate this or identify this as waves 1, 2, 3, 4, and 5. Now, one of the reasons why I said you may not like my answer on this is typically when I see something that is not just crystal clear, I tend to avoid it from a trading perspective. As a trader, I like to focus on quality, not quantity. I think over trading is one of the biggest mistakes traders make. So I put a lot of requirements. I'm very strict, very stringent on my decision-making process when identifying a trading opportunity. And I'm not sure if this one actually fits the bill, but it's certainly something that, along with that HOPE that we were looking at earlier, that I certainly would be willing to put on a, say, a watch list, meaning I would simply look at it probably on maybe a once-a-week basis to see if anything exciting begins to develop. Because you do have an uptrending market, a series of higher highs, higher lows. You certainly have had some acceleration this year, January, February. I certainly would say this is going to be going higher, and I'll go ahead and throw a number out there from current levels. I would probably say this thing's going to go up in easily another $10 to $15 a share. So I'll wrap up with that point. And everyone, again, thank you so much for joining me. I know I was a little quick in my presentation. I tend to be quick. I drink a lot of coffee. But also, too, I'm very excited about what I do. I love trading. I love technical analysis. And I love teaching. And I certainly could do this for another 3 or 4 hours and not break a sweat. In fact, I've been doing this for quite a while. But thank you so much for spending your evening with me. I hope you walked away with at least 1 or 2 things that you might be able to use. If nothing else, I piqued your curiosity. So again, thank you so much and have a great evening.
Jeff, that was good.
Oh, you like that?
Yeah.
Awesome, awesome. Well, Steve, thank you for hosting me. I really appreciate the opportunity.
All right. Well, thank you, and everybody, take a look at some of Jeff's stuff. He is one of the leading experts on the Elliott Wave. You work with Bob over there, just north of Atlanta?
Yes, the home office is located in Gainesville, Georgia. That's where Robert Prechter's outfit is. And I started back with Bob and Dave Allman in that group back in '93, I think. And since then, I've had the opportunity to travel all over the world. I even taught at Georgia Tech. I taught technical analysis at Georgia Tech for 5 years as an adjunct instructor. A lot of fun.
Wow, I didn't know there was any universities that would allow technical analysis to be taught on their campuses.
Well, it's actually very rare, Steve. There is another university I'm somewhat associated with. That's Golden Gate University out of San Francisco. There's a bunch of great guys and technicians there, part of the American Association of Professional Technical Analysts. And in fact, kind of an interesting story. If you look at the book, Technical Analysis of Stock Trends. It's kind of like the Bible for a technical analyst, and it's written by Edwards and McGee. I reference it in all my work. But there's actually, if you notice the title, there's actually a third author, Bassetti. Well, I actually had the privilege of meeting him and having dinner with him and his lovely wife a few years ago in San Francisco at the Golden Gate University group. So it was nice. I enjoyed it.
Well, the last time I saw Bob was there was an investment group that would sponsor a weekend right up on the north border of Georgia. Mm-hmm. And I can't remember the name of the place, but they invited me, and I had the honor of talking right after Bob and right before Ralph Acapora. I thought, oh boy,
yeah.
I'm with you.
Awesome.
I'm here with you. Yeah, I was with the big boys, and it was up there in the mountains, and we were really squeezed in. You had 45 minutes to talk, and then you had 1 minute to get set up. So I think Bob had just finished. I had just set up, and just as I was starting, I got a nosebleed that wouldn't quit. We couldn't stop, so I had a big handful of Kleenex in my hand, holding against my nose, trying to do a 45-minute presentation. So I know that really impressed Bob, but very nice guy. So tell him I said hello.
Hey, it's impressive that you still stuck through it.
We didn't have any choice. We couldn't reschedule anything because everything was so packed together. So, anyways, very good stuff. Everybody, take a look at Jeff's information. I think you'll get well worthwhile as far as looking at his information. So, with that, everybody have a good.
Thanks for joining me.
Yep. Everybody have a good evening. We'll see you bright and early in the chat rooms. Thanks, Jeff.
My pleasure, Stephen. Bye-bye, Becky.